The test wants you to have a basic understanding of currency exchange. You must know that foreign currencies trade in pairs in the Forex marketplace. So if you ever wanted to get into currency trading, the currency trading occurs in the Forex marketplace. It's an over-the-counter marketplace. Currencies always trade in pairs. So you would trade dollars into euros, or dollars into yen, or a British sterling pound into dollars. The concept of a currency appreciating or depreciating is something that you need to be comfortable with for your exam. A currency is said to appreciate if it rises in value on the foreign exchange market, if it buys more units of a foreign currency than it did previously. So if the US dollar is appreciating, it would buy more foreign currency now than it did at some designated point in the past. If a foreign currency falls in value on the foreign exchange market, we said it would be depreciating. In this case, it buys fewer units of another country's currency. We already introduced this concept with imports and exports and a strong dollar versus a weak dollar. So depreciation of the US dollar is good for United States exporters. That means that our goods and services produced here in the United States are more affordable for foreign countries to purchase. If the dollar is weak, goods produced by other countries become more expensive here in the United States. This would discourage United States consumers from purchasing foreign-produced cars, for example. So a weak dollar improves the balance of trade. It lessens the trade deficit. We had talked about that. I think it's helpful to have a basic understanding of currency exchange quotes to be able to understand what it is that they mean. So if the quote was euro, US dollar, let's say the quote was 148. What does that mean? It means for 1 euro, you would get $1.48. So here's the quote, euro versus US dollar. So whatever comes first is the 1, if you will. So for 1 euro, you would get $1.48. Does this sound like a dollar that is strong or weak? The dollar here would be weak. You would rather have euros than dollars. Does that make sense? So if it was 1-to-1, they would be even. But if 1 euro converts into almost $1.50, that would be good if you held euros. So the dollar in this position, the dollar is what we would call weak. So another way of saying the very same thing, so this shows us a weak dollar, very same day, if we were to look at a quote for the US dollar versus the euro, it tells us 0.67, and it goes on more places than that. We'll say 0.675. So if you were here in the United States and thinking of traveling to Europe on vacation, and you had 1 US dollar, so $1, you could exchange your dollars for how many euros? 67.5 cents. That's a dollar that's weak. This is not a good time to go traveling to Europe. it's expensive when the dollar is weak. Lots of tourists would come here to the United States, but not as many Americans are going to go traveling abroad because our dollars don't go very far. The lunch that you have costs you $300 because the dollar is weak. So there's good things and bad things about a weak dollar. Some of the pros of a weak dollar would include international firms are able to purchase more products from the U.S., resulting in an increase in exports. We talked about that. The employment rate in the U.S. would go up as well because we would need more people to create these exports. The trade deficit will decrease because the dollar is weak because of our increase in exports. And a weak dollar attracts foreign investments into the United States. Foreign investors will invest in U.S. real estate, businesses, and other investments. So if you were a business from Europe, your euros would go farther here, so you might buy up some American businesses that you wouldn't have purchased if the dollar had been strong, for example. Cons of a weak dollar include an increase in costs for U.S. businesses to import goods. As a result of the cost of these imports being more, usually U.S. businesses will have to raise their prices for consumers, which creates inflation. Another con for a weak U.S. dollar is that it costs American tourists more to travel abroad. We talked about that. None of my friends are going to Europe anytime soon. When the dollar is weak, there will be less foreign investments in U.S. treasuries, T-bills. And U.S. treasuries are used to finance U.S. government expenditures. When the dollar is weak, foreign governments don't buy nearly as many treasury bills as they do when the dollar is strong. Let's look at another quote. This time the quote reads, Euro versus U.S. dollar. Euro versus U.S. dollar. .93. Now you're an expert at reading currency exchange quotes. You know that this means for your 1 euro, you would get not even $1 for your 1 euro. So the dollar must be what? Well, if what we just did showed you that the dollar was weak, now the dollar must be strong. So another way of saying the very same thing, but US dollars versus euros. So for your 1 US dollar, you would get 1 euro and 7 cents. So the dollar here is stronger than the euro. This was the case on July 24th of 2000. So the dollar has gone through periods where it was strong against foreign currencies, goes through periods where it's weak against foreign currencies. There are, of course, pros and cons to a strong dollar. So pros of a strong U.S. dollar include it is cheaper for U.S. businesses to import from foreign countries because imports cost less. Because the dollar goes further, the foreign currency has depreciated. The reduced cost may be passed along to consumers in the form of lower prices. When the dollar is strong, then we go take our trips. Then we go to Europe. The meal doesn't cost $300 anymore. Now it costs $60 for lunch. Hotels are less expensive. Souvenirs would be less expensive. Cons of a strong dollar would include foreign businesses are less likely to import from the U.S. since they can trade more goods for their money with a different country. So just because a foreign currency is weak against the U.S. dollar doesn't mean it's weak against, let's say, the yen. It might be strong versus the yen, but weak against the dollar. So maybe the foreign company does business with Japan instead of the United States. So that would be a con. When the dollar is strong, the U.S. is most likely to export less due to a lessen in demand from foreign countries. This hurts American companies by reducing their international sales. We talked about when the dollar is strong that the trade deficit will do what? It will increase, of course. So do I expect on your test that you're going to have to read a quote, that you're going to have to know that if in fact this quote, US dollars versus euro, says a dollar, if it says 107, do they ask you, what does that mean? Not necessarily, no. I think, however, that it's important. You can't really start to read the articles as it relates to the trading of foreign currencies unless you can understand when you see this. Maybe you get an MSN feed on your phone or CNBC feed, or maybe you get the Wall Street Journal. If you see that quote, you have to be able to understand what it means, and then conceptually all of the other things that we've talked about hopefully will make more sense. So whichever one is first, that's the currency that we're talking about. The euro converts into, 1 euro converts into 93 cents. Or $1 converts into 1 euro and 7 cents. So whatever comes first is the currency that is the one, if you will. So go read those articles. I think you'll be able to understand them now. You will have a couple of questions on interest rates and yield curves. There's lots of different yield curves out there, but the one that is the focus of the test is the yield curve for U.S. government securities. So in order to plot the yields, we have to first review the different U.S. government securities. Treasury bills, Treasury notes, and Treasury bonds. So the U.S. government sells debt. There are short-term debt instruments, Treasury bills. They are sold at a discount. They mature in 4 weeks, 13 weeks, 26 weeks, and 52 weeks. There are Treasury notes. Those mature in 1 to 10 years. And there are Treasury bonds. Those mature in 10 to 30 years. So Treasury bills sold at a discount. They make up the bulk of what we call the money market, which is where very liquid, as close to cash as you could get trades, things that mature in a year or less, trade in the money market. Treasury notes and Treasury bonds both are sold at face value and pay semi-annual interest. So if you were to plot the yields of Treasury bills, notes, and bonds, and you were to find that the yield curve went up, this is what we call a positive or a normal yield curve. If I was to ask you, you had a choice of investing in Treasury bills, notes, or bonds, which one would you demand as far as you're the investor, the highest yield? What would you say? A Treasury bond. Well, if you're normal, you would say a Treasury bond. So we sometimes refer to this as a normal yield curve. The main causation of a normal yield curve is this expectation that an investor putting in their money for the longest period of time is going to demand the highest yield on the longest term instrument. So the Treasury bond is going to have the highest yield. So the test is going to ask you a question about what happens to the yield curve if interest rates change. And really, in order to describe to you what would happen to the yield curve, I need to do a review or a preview, depending upon where you're at. If you have your Series 6 or if you have your Series 7, what I'm going to do now, you already know. But if you don't have one of those licenses, this is just a preview. I'm going to do this again later on in the course. So I'm just going to tell you a story. So in my neighborhood, there's a new family. They just moved here from New York. Their name is the Bonds. So this is a story about the Bonds family. And in our neighborhood, we have a park with a teeter-totter. And they have 3 kids. Their oldest boy is named Price. And then their 2 younger boys, they're twins. Their names are Interest Rate and Yield, poor children. And all of these children were born in New York. That's what we call the nominal yield on the bond. The nominal yield on the bond never changes. It's like a tattoo on my chest, if you will. It's there forever. It's not going to go away. The kids were born in New York. That will never change. What happens, however, is that these debt instruments trade in the secondary market. And what drives the price, so Price is over here all by himself on the teeter-totter. What drives price up and down is interest rates. If interest rates go up, price goes down. And if interest rates go down, price goes up, right? So there's this idea of this inverse relationship between price and interest rates. The test loves this. This is one of those concepts that I'll go over again and again and again until you're sick of me saying it. So it's a light bulb that will eventually go off for you. Right now I'm just previewing it. The test question is something about this concept of if interest rates go up, price does what? Price goes down. If interest rates go up, what do the yields do? Interest rate and yield, they're twins. They go together everywhere they go. So if interest rates go up, then yield goes up too. So the question is something like this. The long-term interest rates in the economy have gone up. This is going to cause the yield curve to do what? Stay the same, flatten, or steepen. Well, if long-term interest rates go up, then we know that the yield curve itself is going to steepen because interest rates and yields on these instruments in the secondary market move in the same direction. Interest rates and yields move in the same direction. So if interest rates go up, the yield curve will steepen. Always a test question. If interest rates are all right about the same, if you were to plot these, we would call this a flat yield curve. Flat. And if interest rates on the Treasury bill was higher than the interest rate that you find on the Treasury note, which is higher than the interest rate that you find on a Treasury bond, this is not good. This is what we call negative or an inverted yield curve. So watch the yield curves. The yield curve has been a precursor to recession. A negative yield curve has been a precursor to recession almost every single time it's happened. And it was that way before the last recession that we went through here in the United States. So it is something to keep your eye on, the yield curve. So it is not normal for the Treasury bill to have a higher yield than the Treasury note, than the Treasury bond, which reminds me of something. The current yields are not normal, meaning that the fact that a Treasury bill is paying next to zero, which is true right now, you've got to forget about it. Forget about it. That's not the way it usually works. So we are in a somewhat interesting period in the economy where we do have a positive yield curve, but we have really low yields on the shorter term instruments. The test does not talk about that at all, meaning that when they use what they call the risk-free return, the risk-free return is the rate of return that you could earn on a Treasury bill, and we'll reference that a few times throughout the course. You have to assume it pays something. You have to forget that there has been periods where it's paying next to zero right now. So forget about that. Just assume it's paying 2% or 3%, even if it's not currently doing that in the economy right now, for real. Forget about the real world as far as that goes. So sometimes we'll have suitability questions where they ask about someone who's looking for safety and income. And the only answer that there is T-bills. And you think to yourself, but a T-bill doesn't pay anything. You have to forget about where the T-bill's at currently. So a couple of questions on the yield curve. We mentioned already what we look at if we're measuring inflation in the economy on the consumer level is the Consumer Price Index. It measures the price change in a basket of goods in all these different cities across the United States. It's the same basket of goods in all these different cities. We can also measure the goods on a wholesale level, which is called the Producer Price Index. Now, we go from Econ 101 to being able to read the business section of the newspaper, to being able to understand a little bit about what is called fundamental analysis. So this is your accounting class, fundamental analysis. Fundamental analysts look at financials. So Warren Buffett is one of the most famous fundamental analysts that's out there. He likes to read companies' financial statements. So we're going to cover financial statements like your Accounting 101 class would have, maybe a little bit of a 201 level type class as well. A couple of questions for the test in this area. What do you find in income statements? What do you find in balance sheets? What do you find in the statement of cash flow? So we have to have a basic understanding of these different financial statements and how they work. Now, if you were to be an analyst that made charts and graphs, looked at price over time and plotted that, cared about the number of shares that were traded today, that's what we call a quantitative analyst. So there's fundamental and there's quantitative. Fundamental is sometimes called qualitative analysis. So we're looking at the financial statements. And there will be three that we care about. So there's the balance sheet first. So the balance sheet talks about what a company owns and what they owe as of that picture, that moment, that snapshot in time, as of today or as of December 31st. Where the income statement looks at the money that the company has brought in, and then the expenses of the company, be them cash expenses or non-cash expenses like depreciation. How much money did the company keep in the end? Net income or net loss, it could be. Over a period of time. So the balance sheet is this snapshot, this picture of a moment where the income statement is over a period of time. We'll also discuss a little bit about this statement of cash flow, which looks at the cash that comes in and the cash that goes out, just the cash of the business, also over a period of time. So I think a lot of students get nervous in this section. There is a lot to know, and it does take practice to master these, but you have got to have a basic understanding of each of these because I expect a couple of questions on each of them. Accounting is my background, so it's something that I'm really comfortable with, and hopefully you will understand it better as we go along. So financials, we're going to start off with the balance sheet. We could be looking at the balance sheet of a corporation and trying to decide if this stock is a good purchase for your client. We could be looking at the balance sheet of your customer. So there's two different equations that I want to discuss before I get into the details here. If we're looking at a corporation and we're manipulating the balance sheet, I want you to use this balance sheet equation. Assets equals liabilities plus owner's equity, which is shareholder equity. Owner's equity. If we were looking at the balance sheet of your customer, more likely you would look at it like this. Assets, what they own, minus what they owe, liabilities, equals what we call net worth. Assets minus liabilities equals your customer's net worth, which is generally the most they have available for investing. Whether or not your company that you work for allows them to include the value of their primary residence within their assets in determining their net worth depends upon your company and any subsequent rulings that have been made. So I don't have to get into that, and the test won't get into that either. I just wanted to mention that because that commonly comes up from my students. Assets minus liabilities for your customer equals net worth. I can promise you, you're going to have a question about a customer's balance sheet, and it's going to start off with their net worth is, let's say, $500,000. And they took money out of their savings to pay off their credit card, and they took cash out of their account to buy some furniture, and they did this and they did that, and they did this and they did that. And the question is, how much is their net worth when all is said and done? I'm telling you right now, pick the same net worth. Don't deal with manipulating the balance sheet. It will save you 5 minutes, and the answer is always that their net worth stayed the same. Okay? So when you see that question, you'll know Susie said, don't go through all the manipulation. Just pick the net worth as the same and move on. Because that question can take a lot of time, and we can work through it, but a lot of times you're time constrained on these exams. So the last thing I want to have happen is for you to run out of time towards the end of this test. So pick the answer where the net worth stayed the same, and you'll be fine. So we're going to go to not our customer's balance sheet, but we're going to look at the balance sheet of a company. And we're going to have to learn about the different kinds of assets. There's different categories of assets. There's current assets, there's fixed assets, and there are what is called intangible assets. So current assets are things that are cash and expected to be cash in the next year. Accounts receivable would be a current asset. Marketable securities that the company owns would be a current asset, as is their inventory. Current assets. If the company buys a building or buys a machine, they own land. That's what we call a fixed asset. Land, buildings, machinery, fixed assets. And an intangible asset is things like goodwill, intellectual property, patents pending. Those are intangible assets. So the balance sheet equation, it's designed this way for a reason. We have what we call double entry bookkeeping. So let's say that the question says that the company bought a machine for $5 million and they paid cash. We need to understand what happened to total assets. Nothing. But how's that possible? So if they bought a machine for $5 million, their cash went down by $5 million, and their fixed assets went up by $5 million, so that their total assets stays the same. Concepts like this is definitely going to be on your exam. If we have current assets, we must have current liabilities. So assets, things the company owns, liabilities, things the company owes. So if it's a current liability, it's owed within the next year. So we have accounts payable, and we have accrued wages, accrued interest, and accrued taxes. Now, there's an important thing that comes from these current assets and current liabilities. Current assets minus current liabilities is what we call working capital. Working capital. It's a measurement of a company's liquidity, their ability to maintain themselves through a short-term economic crisis. It's what they own, the current assets, minus what they owe. So working capital. It's one of the things that you would look at as a fundamental analyst. Now, this is it as a dollar amount. If you were to take current assets and divide it by your current liabilities, this is something that's even better to look at. It's called the current ratio. Because this ratio is something that you can compare a large company's financials with a small company's financials within the same industry to see who's stronger, who's better able to maintain themselves through a short-term economic crisis. So one of the things that has happened recently is companies have become hoarders of cash. So we see lots of cash on corporations' balance sheets currently.